Welcome back, traders and investors. We're going to go fundamentals here a little bit with Barry James, President and Portfolio Manager with James Investment Research and President of James Advantage Funds. Barry, how you doing this morning?
I'm doing fantastic. Thank you.
Thanks for coming on our show. Now, you have quite a diverse education and market background, and also a tour of duty in the Air Force.
Yeah, that's right. All things that are required, of course, when you're looking to get into investing. Not really. I went to the Air Force Academy, and then I was an instructor pilot. And while I was in the military, I went to Boston University. They had a graduate program overseas in Germany, and the first two classes I took in my master's accounting and finance, and I said, "Hey, I really, really like this. This is really interesting stuff." And of course, my family had been in the business. I was the first employee at James Investments that was actually paid a salary. My dad started a company, but they weren't paid. He wasn't paid. He was just having fun. As kind of a hobby that turned into a job that turned into a career. In fact, so I left the Air Force. I was trained. I facetiously tell folks I was trained to fly 100 feet above the ground at night in the weather through the mountains while being shot at, and I wanted something a little riskier, so that's why I wanted to go into the stock market.
Okay, so here you are. Now you're
Yeah.
back in the markets here, and so what do you like to rely on? Are you do you do are you more of a fundamental trader? You look at the fundamentals, or you more of a technical trader?
Well, I'd say yes. What we care about is what actually makes our clients money. As we look at investing, we come at it from a little bit of a different perspective. We've been around over 40 years, and I guess the biggest thing that we're known for is preserving capital. So we always put risk first. We say, what's the least amount of risk we can take that won't prevent upside? So as we look at investing, we always want to go through that filtration system. So we care about what actually will help us not lose as much money, but at the same time won't prevent us from making money. So we use both fundamental and technical. My father, in his doctoral dissertation back in the 60s, is the person that actually discovered relative strength.
Mm-hmm.
He's the first person to disprove the random walk, and he did that in his doctoral dissertation at Rensselaer Polytechnic Institute. And so that, that's about as technical as you get. So the stocks that are going up at a pace faster than the market over a long period of time are likely to continue doing so. And of course, that's just like if you watch baseball, the guys that hit 300, that's the guy you want up when the game's on the line, not the guy that's hitting 150. So that is part of it. But we do believe that the fundamentals are like an insurance policy. They help you prevent the big disasters in your portfolio and with an individual stock. So we do look at those fundamentals. Valuation is probably about half of what we do. And it's not always the same methodology that you'd see on Wall Street. It's not just PE and price to book and price to dividend and that kind of stuff. That's just a starting point. You need to delve within the company a bit more, looking at things like cash flow from operations, and what they're doing with their own money. Are they buying shares back? That's always a pretty good sign. So there's lots of pieces of the puzzle. So I put it into three categories real quickly. Number one is valuation. Number two is earnings. And number three would be that relative strength. And as you can see, probably two-thirds of what we're looking at are things that, fundamentalists would be looking at. The one thing we don't do is rely on what the analysts are projecting as far as earnings. They're very, very bright people, and often, they have insights that I would never, ever have, but it's already built into the market for the most part. And we do all our own research because we want to know who to blame if it doesn't work. But nonetheless, what we find is that if you're following Wall Street's expectations for earnings, you think of Apple a couple of years ago, everybody said it was going to do great, and then it had a terrible year because it was already built into the price. So you want to try to find those pockets where it's ignored by Wall Street but has very, very good historical earnings gains. It's cheap, and the price is going up. So it is being recognized on Wall Street, and it's got the potential to continue doing that for years. But if you use this approach, and we rate 8,500 stocks using this approach, what it does is it'll rotate you through the sectors of the market and different sizes and so forth over periods of time. But it keeps you in a relative group that we call our bargains. They're cheap and they've got good earnings. Why wouldn't you want to own them? And when the inevitable correction comes, what does not go down as much? Stocks that are cheap with good earnings. That's
So what
unchanged.
is cheap out there now? Here we are at the markets at all-time highs. So there's the $64,000 question here, and if you say nothing, I'll respect that too. But what's looking cheap out there to you?
Well, we look at the world in a relative view in terms of stocks. So there's always things that are relatively cheap. The one area that we're liking right now is energy. To be perfectly honest, we see that energy production in the United States, of course, is ramping up. We're back to levels we've seen for oil production in the 1980s. Next year, we could be the largest oil producer in the world. And of course, natural gas, and you even have UPS now using liquefied natural gas in a lot of their fleet. So all of this is domestic. So we look at it from a couple standpoints. It's not necessarily the drillers, because eventually, after we get through some of these problems in the Mideast, we'll probably see oil prices start to cool off. But companies that are transporting it, some of the companies such as Greenbrier, which is a rail car. They've got a record backlog right now, and they've gone from 9,500 carloads in '08 to over 400,000 carloads of oil in 2013.
Wow.
So they're ramping themselves up, and they meet that criteria. Vectron, which is more of the delivery on that end of it, and then refiners we think are going to have a real heyday once the price of oil comes down from above 100. That's when refiners start to do well. So those are three within the energy sector that we really like.
Okay, and so your outlook for oil here, crude oil, we got pumped up on Iraq and Ukraine and stuff, and made that run over to 107. Currently trading at 106 in the futures market. So are you looking for crude to hold these levels?
I think that the long-term pressure will probably be downward. We don't have such an increase in economic growth around the globe that we have the highest levels of demand. So once you get through some of these flash points, if you will, which have kind of elevated the price of oil, we think that the natural bent will be for oil prices to come down. We've reached that level in the United States where our extra production here is having an impact worldwide. It's just you just don't see it today, primarily due to what's going on in the futures markets and people's worries about the Mideast and the Ukraine.
Okay, when you were talking about your fundamental analysis and your three-tiered approach, does this preclude you to buying companies with high PEs, because those are been of some of your momentum stocks and stuff? Is that using this three-tiered analysis, does that still allow you to invest in these stocks that are trading at very high PEs?
Well, generally speaking, not really high PEs. They might be elevated. A Greenbrier, for instance,
What's
has
the symbol on Greenbrier?
GBX, Golf Bravo X-ray,
Okay.
and it's in the 20s today. So you wouldn't call it the absolute cheapest. What we find is that it's a relative value approach, where one part may pull down our view, but another part pulls it up. And the one thing that we have found that doesn't work for us is that you use a screening technique, a PE above or below a certain level. That doesn't work in the long run, because you wind up wiping out a lot of really good companies that have all these other factors that you're looking for. So we developed actually a rating of these 8,500 based on the culmination of these different factors. And of course, it's always what's the most important. Is PE most important, or return on assets the most important? And figuring out those weightings. And the one thing that we found, being a research firm, is that you have to continually upgrade yourself. You can't just say one time one size fits all. And that's why over a 2-year period we revalidate everything we do, because the markets, to be honest, change, and they reward different aspects. Used to be earning surprise was very valuable. It's almost worthless now. So, you have to continually keep your eye on what's really, really important, and what's likely to continue working well over the years to come.
Okay, as we discussed, some of the stocks in the energy sectors being attractive on your buy radar. Is there anything you're selling here at all-time highs here? Just kind of ringing the cash register, just according to your models, things are at your price targets. Is there anything that you're lightening up on?
Well, we've been continually, I call it taking out the trash in the portfolio, things that don't meet the same high criteria that we're looking for. And when you look at investing, and excuse me for going a little bit into some of our thoughts on this, but what we find is if you're not in the very best, then you're losing opportunity, and you need an approach that says it's time for me to move from this stock into a better stock. So, as we're looking around, we see those that have had the big run-ups. The earnings are not keeping up, and the biggest thing today is if the stock hasn't been keeping up with the overall market and exceeding it, there's really not much reason to hold on. And that's the one good thing about relative strength. It gets you to sell your losers and hang on to your winners. And it's so hard to find a winner that you want to have some
You want to hold
confidence
on
that
to
you
it.
can. Yeah.
Is there
So the
anything
other
that's
thing,
not meeting your criteria right now? Any sectors or any individual stocks?
well, the sector-wise, we probably seeing that utilities have had a big run this year, and so we're not saying to get out of them by any stretch of the imagination, but we would be lowering our overall targets there. They were, of course, helped by what went on in the fixed income arena and the fact that they were despised last year. They've been seen, kind of again as a safe place, and they're one of the top sectors. So that would be an area that we would say you don't want to be overweighted in right at this juncture. Whereas as I was mentioning earlier, energy we really like. Technology also is an area that we think is a little bit overextended, even though it's kind of been pulling back recently. And an extension of that are all these initial public offerings. We had a crazy year last year where IPOs did spectacular. That is not the norm. Our research says they lose money the first year. So we would say that IPOs would be something that we would not be chasing at this particular juncture.
Are you one of those investors that you never sell, you never go flat, you never go a high percentage of cash, you just kind of sticking with the trends up and down, or is there a point are you fully vested at these levels? Do you have some cash on the sidelines? How do you gauge that?
That's a great question. We are active in terms of allocation between stocks and bonds. The one fund we have, the Golden Rainbow Fund, GLRBX, is an actively managed. So today we're about 43% in stocks. The rest have been in bonds, and that's been the lower risk, higher return so far this year. Maybe not last year, but certainly this year. So we do, and we can go from say 30% in stocks as we were in '08 when the market kind of crumbled to we can go to 70-80% in stocks. Not that we get there very quickly because we don't know that time of that the market's going to peak or not. But we just see that we're in a little bit of a higher risk area right now. Not necessarily a collapse in the market, but we just think it's better to be prudent with stocks at this juncture.
Okay, and do you use options at all for part of your strategies?
Not unless the client says, "Hey, I want to do covered calls" or something like that. Occasionally, personally, I'll do maybe a synthetic long, buying a call and selling a put. But that's only when we're at extremes. In a time like 2008, where prices are just crazy stupid. Then we can make money. What we found, we did a study, and we had an options strategy, and it made money every time on paper. And then we tried it in real life, and we never made any money because of bid ask and commission. So we said, no, that's not us.
Yeah, there you go. Paper trading. We had someone on yesterday that mentioned the same thing. I think it was for foreign currency trading, and also you just take out the emotion when it's not the real money. You're not taking
Exactly.
the heat on the downside. So Barry, great run in the market here. Obviously, we just came off a quad wage expiration. Very, very muted activity in the markets on Friday and Monday. Is just symptomatic. Another consolidation, another blast higher. Or is there something you've seen on your radar that makes you a little bit worried? And if you're not seeing anything, what could finally derail this bull market?
Well, we think right now we've got this irresistible force is meeting an immovable object, and the irresistible force has been the market's just been going higher, and that's always good. We it's not just that we like to see it, but momentum tends to beget momentum. So you've got that in place. And the other things that's really positive is we've seen an overall reduction in the number of shares available. So that has been very, very positive, and you have all this merger activity keeping that at pace. So that's the big support to it, and probably the biggest support has been the Federal Reserve and quantitative easing. During quantitative easing, the market's gone up at a 23% annualized pace. The immovable object is they're taking that sugar bowl away. And when they've cut that since 2008, the market has had a correction generally on about a 20% annualized pace. So that's starting to bleed into the market, and I think that's why the market is kind of it's fizzing, but it's not rising, if you will. And so that's kind of a concern to us. And it's getting into people's psyche that the Fed isn't there to continually support and push people into stocks. The things that we usually look for a major correction would be valuations are too high, sentiment is too positive, and the economy is on the cusp of a major recession. And we don't really have any of those giving this red flashing light saying we should see a collapse in stocks. So I have the opinion it's going to be more like paper cuts in the market, that it's going to be painful, but it doesn't do a whole lot of damage, but it's probably going to rotate through, and we're going to see maybe a rotational type of correction where the market, as it has so far this year, it may be at new highs, but it hasn't really gone anywhere this year. And bonds have done so much better. So I think folks are going to get a little bit frustrated, and when maybe in the next 3 to 6 months we'll get that level of frustration high enough where we can have then another real nice run in stocks. But we're thinking that there's higher levels of risk in stocks. That's why we're less than 50% in stocks in our balanced accounts. But we don't see this raging need to get completely out of stocks at this juncture.
Okay, we've had Barry James on, president and portfolio manager with James Investment Research and president of James Advantage Funds, giving us a very measured outlook on the markets and a look at his investment strategies. Barry, thanks for coming on, and certainly like to have you on again.
Well, thank you. My pleasure.
Okay, Barry James.